All right, so I want to sketch this out. We're going to talk about why the sacred account is actually better for saving money. We do need to save money. So again, you guys have seen this before. This is called the triangle of wealth, right? So on the triangle of wealth, we have this triangle. We have 3 points. We have earn, we have save, and we have invest, right? And so the goal here is to earn income through production, save, keep as much of that income as we can, invest that income into something that produces more income. And this whole thing cycles. Then we can earn more because we invested in something that paid passive income. We can then save even more because we're repeating the successful actions that got us there. Then we can invest more again because we saved more, right? So the ways that I can go about this, I can do this with a bank, right? So we talked about with a bank. And what I'm going to show you is with a bank, if I put money into it, I'm earning national average savings account pays 0.05% right now. So I'm earning 0.05%. So while it's there, I don't really get anything, right? Would we agree with that? I don't really make much on that. Now I can take this money out that's at 0.05%, and I can then put that into an investment. Let's say that I do a real estate investment. Okay. And this might pay me some money as well. Now with a bank, common sense is when I have the money in the bank, it's not in real estate because it's in a bank. It can't be in both. When I take the money out of the bank, it's no longer in the bank, which means I don't make this money and I only make what's in the real estate. That would make sense. That would seem to be the normal way it would go. Now, the problem here is I would like to earn money on both. Now, I know a bank's not going to do that, right? So I'm either going to only make 0.05% because I left it in there, or I'm going to only make, let's say 8 to 12% in real estate because I took the money out of the bank and the bank no longer pays me that 0.05%. Okay. So that's with a bank. The other place I can put this that we talked about is a retirement account. Okay. So if I put this in a retirement account, this is first not even going to go in real estate. It's probably going in the stock market. So the idea of me being able to put this money in a real estate deal and make passive income is not real because it's in a retirement account. So if I put my money in here, in the stock market, the average mutual fund investor over the last 20 years made a fee adjusted return of I believe 3.88%. So it means after they paid fees, this person made 3.88%. Okay. Now, if I have money in here earning that return of 3.88%, I can't do anything. I can't have it. I can't use it because I'm in a retirement account. I'm not allowed to access any of this money till 59 and a half. Age 59 and a half is when I can start taking penalty-free withdrawals. While it's in there, it's just going to be in whatever funds I was allowed to put it in. Even if I do a self-directed account, which we do these all the time, but it's still not going to generate passive income that I have today, right? So if my goal is to increase my passive income, putting money into a retirement account is not going to help me get there because it's not going to make the same return. And while it's there, it's locked up till age 59 and a half. So in a bank, at least I can use the money, like at least, even though it's only paying me 0.05%, at least I can pull the money out. With a retirement account, I can't even do that. Right? So that's not an ideal place to put money because I want to have access to that money now. With the sacred account, again, this is life insurance. With the sacred account, we have, let's do a little timeline here. We have, let's say $100 that we put into this. Okay. This $100 is going to grow at a 3 to 5% annual compounding interest rate, tax-free. Meaning I'm going to put $100 into it. Over time, I'm going to average an annual compounding interest rate or annual earnings of 3 to 5% each year. Okay, this is my annual growth rate. This is what I'm actually profiting on an annual compounding basis, tax-free on an annual basis, again, yearly. And so what I can do here is I have this money growing. It's tax-free. So I've already beat the bank. I'm already matching what I'm getting in a retirement account, 3 to 5%. The retirement account makes 3.88. So I'm already doing that. But here's the deal. I can borrow generally about 75% of this $100 while it's still earning 3 to 5, right? I'm going to pay probably 1 to 3 in interest cost when I borrow, still make the 3 to 5%, and then take this money that I've just borrowed and put this into that real estate deal that we mentioned that's earning me 8 to 12%. Right? So what happens here, and this is why this is so beautiful, is I'm earning money, I'm earning interest, I'm earning returns on my money in two places at the same time. I'm making 3 to 5% on my entire $100. Okay. While I'm earning that, I can take 75% of this, or $75. I'm going to pay a cost of 1 to 3% on the $75, still earn the 3 to 5, and then take that $75 and put that into the real estate deal. That's going to pay me that 8 to 12%. So if we total this up in the stock market with a mutual fund and a retirement account, I make 3.88 on average. This is over the last 20 years, guys. 3.88 on average is what the average investor made. Can't do real estate. Okay. In the bank, I can make 0.05% in the bank, or out of the bank, I can make 8 to 12% just on the real estate. I cannot have both. With the sacred account, I can make both. I can make 3 to 5 on the sacred account and 8 to 12 on the real estate. So if we add this up, let's say that I make 8% here and 3% here. Okay, that's 11%. If I'm making 11%, let's say that my cost here, let's 1 to 3, let's call it 2%. Let's say my cost was 2%. So 11 minus 2 is 9. So I make 9% with the sacred account. In the market, we just said I only make 3.88. In the bank, I'm only making 0.05%, or I'm only making the 8%. Now, what if my sacred account performs better, or what if my real estate performs better and I'm actually making 12 plus 5? Now I'm making 17. 17, let's say I'm paying the maximum interest that I'm going to pay here of 3%. Okay, 17 minus 3% is still a positive 14% net return that I'm making, right? So this is why we utilize the sacred account, guys. I talked about the purpose of it was to increase the saving and have all these different features, but here's actually what we're going to use it for. Now, let me ask you, does it matter that this is life insurance at this point? No, I'm making a 14% return. It does not matter that it's life insurance. This could be a shoe and I would do it. Right. So I wanted to cover this to give you the conceptual understanding of what we're trying to do with this. You know, prior to the real estate, I'm actually using this to pay off debt. Once we get to the point where I'm out of debt, then I'm doing the real estate with it. But I want to give you the visual concept and show you just the theory of it so that you can practically understand it with your own account. So guys, I will see you on the next segment. Make sure you look up any words you didn't understand, take notes. Talk to you soon.